Hi everyone, Brett Sebion here with Emerj360. I will be giving a market and economic overview, kind of covering the end of 2023 and the start to 2024. Talk about markets, changes that we've made within client portfolios as well. As a reminder, TrustPoint, the investment team, manages and makes changes to the Emerj360 profile. So the presentation we'll be going over is TrustPoint branded. The performance of markets, specifically the U.S. economy, has been quite impressive over the last couple quarters as economic data has surprised to the upside. With that being said, inflation has also surprised to the upside, and we'll get into that a little bit. But this is a 5-year chart of the global stock market. You can see in 2022 was a challenging year for investors. 2023 was the flip side of that. It was a good environment for the stock market. In 2024, the first 3 months through Q1 have been very positive for stocks. It's important to understand that when an economy, the U.S. economy specifically, is operating at or above capacity like it is today, you're going to have these upside growth surprises where economic data is going to come in, better than expected, and markets are going to respond positively to that, like they did. We've had upside surprises to earnings as well, and when you mix that all together, we've had a positive environment for stocks. But again, those upside growth numbers also are associated with upside and inflation numbers, and we'll get into that in a sec. But we can see numerically here, global stocks year to date are up about 9%. So a very strong quarter, not something we would expect quarter over quarter. And over the 1 year, we can see global stocks are up over 25%. Again, not something we would necessarily expect year over year. U.S. large cap growth has kind of been the shining star in the mix. You can see over the 1 year number up nearly 40%. All other asset classes within global equities and U.S. equities are positive, but you can see the outlier is U.S. large cap growth. And I got a pretty good slide here that shows that the market has been led by a very small number of stocks. In this example, we use the Magnificent Seven. They all fall into that U.S. large cap growth category. In 2023, a lot of them, there's a craze around artificial intelligence or AI. A lot of these companies are involved with AI in some capacity. So you think about NVIDIA, Microsoft, Google, etc. So in 2022, those 7 stocks were down collectively 40%, while the rest of the S&P was down about 8% only. So excluding those seven stocks, the rest of the S&P 500. In 2023, it was flipped. The Magnificent Seven returned positive 76%, while the rest of the market was up 8%. And then year to date in 2024, we can see, again, U.S. large cap growth, specifically those 7 stocks have outperformed the market as well. On to fixed income markets. So, while the stock market has traded higher due to those, economic growth, economic data surprises, the market has also had to reassess when and by how much the Federal Reserve should be cutting rates in the coming quarter. So the Federal Reserve actually indicated at the end of 2023 that their next move would likely be a rate cut after going through an interest rate hiking cycle. So the last couple meetings, they haven't done anything with interest rates, but they did tell us that more than likely the next move would be a rate cut. But recent data, inflation specifically, suggests that it may be more difficult than initially envisioned for the Fed to cut rates in 2024. So remember, interest rates are inversely correlated to bond prices. So when rates go up, bond prices go down. That's the environment we saw in 2022. When rates go down, bond prices go up, which we saw in 2023 wasn't as dramatic of a move. But 2024, we've seen rates come up a little bit again, which has put downward pressure on bond prices across the different asset classes, as we see in the year-to-date column. So again, a lot to be monitoring. We'll take kind of the information that we went through and how we applied it to changes within client portfolios. But I have one more slide that has to do with election. So it's an election year, and during presidential election years, generally is a positive environment for the stock market because policymakers don't want to rock the boat, right? There's not going to be any major changes that is going to shift markets in any dramatic way. So the S&P 500 is up on average 11.5% during election years, while all the other years they're up an average of 10%. And stocks have had a positive return in 83% of presidential election cycles. The bottom right is kind of interesting. So during those election years, stocks average a gain of about 2.8% in the first half and 9.34% in the second half. This year so far in 2024, markets were up almost 9% in the first quarter, which would fall in that first half. So we'll see how that materializes. But generally speaking, election years tend to be a positive environment for the stock market. So we have made two different changes in 2024 that have really led to having a more constructive stance on markets and therefore asset allocation. So as we stand today, we are at target for our equity exposure and fixed income exposure within client portfolios. So if you are invested in a balanced growth strategy, the target is 50% equities, and we are at that target today. We're at the end of 2023, we are underweight by about 7% to our equity target ratings across our portfolios. So what this tells us or tells you is that we have a balanced view of stocks relative to bonds, meaning that we're currently not overemphasizing one asset class over the other. Within equities, we still do have biases, and I'll talk about the changes that we had made here. So in January, we increased two areas of the market on the equity side that lagged the broad market in 2023, specifically U.S. small cap equities and international developed. But really, these changes were becoming less defensive by increasing our equity beta as inflation continues to come down and the macro outlook generally improve. We talk about inflation. There's been a few surprises to the upside, but inflation has come down from the peaks that we have seen over the last couple of years. And again, adding to areas that underperformed in 2023 but still present good long-term opportunities. And then March 2024, kind of that same trajectory, continue to realign portfolios with improving economic and earnings outlooks, and increase exposure to secular growth opportunities. This kind of covers that AI or artificial intelligence area of the market. So we increased our allocation to U.S. large cap growth and emerging market equities. So coming into 2024, we are underweight equities relative to our target. We've made two changes so far in 2024 that has gotten us back to target. So our outlook is a little bit better on the stock market going forward compared to kind of in 2022 and 2023. But we're not overemphasizing any area of the market. We're not placing, outsized, bets, feeling very comfortable that certain areas of the market will do better than others. So we're really kind of at those target areas after these two changes that were made in 2024. So I'd like to thank everyone for coming on and listening. Please reach out if you have any questions. As always, appreciate your business, appreciate working with every single one of you. So please reach out if you have any questions on the market overview for Q1 or anything else. Thanks, everyone.